A few weeks back, we shared the new concept of FANG 2.0 that had been making the rounds on Wall Street. Fuels, agriculture, aerospace, nuclear, and gold. The seemingly new ingredients for the 2022 portfolio, which still looks to be holding true. In that episode, we discussed the handover in leadership from the old FANG stocks, such as Facebook, now Meta, Apple, Amazon, Netflix, and Google, and what it means for your portfolios. But there's another aspect beyond just the major technology stocks. This recent and potentially meaningful rotation has had a particularly dramatic effect on the performance of ESG strategies. That's environmental, social, and governance strategies, which tend to be coincidentally weighted towards quality and growth factors. The recent commodity surge and the ensuing growth to value rotation has sparked a debate about whether this is just a short-term cyclical blip or something more structural that could be with us for years ahead. And that's today's big conversation. At the heart of this discussion is the current state or shape of the United States yield curve, as measured by the 10-year yield versus the 2-year yield. Having recently inverted where the 2-year yield is higher than the 10-year yield, is the curve sending a warning sign of an impending recession? If so, perhaps all those arguing that the value trade is just a short-term cyclical blip will be proven correct. But what if the recent commodity strength is just the beginning of a structural bull market in commodities? Well, oddly enough, and this is the difficult copper pill to swallow, the structural argument in favor of commodities and value over growth is indeed the world's transition towards more sustainable investing. Lithium, cobalt, nickel, and many other raw and rare earth minerals are projected to experience a surge in demand to fulfill the very needs of renewable energy efforts like electric vehicles and better electrical grid systems. Take, for example, the fact that metallurgical-grade silicon, which is used in solar panels, requires coal, oil coke, and wood chips, among other materials. This raises the question, is the recent rotation towards value, which includes many names in the oil and gas and metals and mining sectors, purely a stock market rotation, or is this a space that could see large-scale institutional activity in the future? And let's be clear, this would not be institutions voting for less clean energy. It would be the necessary portfolio rotation required by them so as not to miss the surge in demand and therefore performance. Now, if this is a blip, then major rotation is less likely, but it's important to recognize that the longer commodity prices stay elevated, the more institutions need to chase price, and so the virtuous circle begins. Now, let's pause for 1 second there and look at this from another angle. Historically, high commodity prices have brought about a flurry of M&A activity and increased capital expenditure for the new mines, all the way from copper through to gold. Now, today, we're seeing a much slower reaction function, as depicted by the slow and reluctant rise in new oil and gas rigs. The same can be said for the broader mining industry, which has its own complicated history of environmental impact and human rights issues. Will stocks like Peabody Energy, which is up nearly 24 times since the November 2020 bottom, see increased institutional demand should there be a persistent need for coal as a primary source of electricity? Will capital markets, particularly in credit, be willing to provide billions of dollars in financing for new mine projects? And let's not forget that reopening mines is no small task. Or will investors require even higher commodity prices to entice increased supply? These are all questions we should be and need to be asking ourselves as we look out into 2022 and beyond. And as I mentioned before, if the yield curve is correct in predicting a recession somewhere around the first half of 2023, perhaps the recent value rotation will quickly lose steam. And if value does begin to lose steam, perhaps the recent rotations were just a cyclical blip within a longer-term structural trend towards growth. And if so, and that's what you believe, then the recent correction in ESG strategies, along with a re-rating of many higher multiple quality and growth stocks, seemingly does present an attractive opportunity. More importantly, this washout could prove to be a great time for long-term investors to increase their exposure towards sustainable investing via high-quality companies with stronger corporate governance and ESG compliance. To gain more insight on this topic, I sat down with Cornelia Andersson, Head of Sustainable Finance and Investing for LSEG. Hey Cornelia, thanks for joining us. Welcome to The Big Conversation.
My pleasure, Jamie.
So we've been talking in recent weeks about this shift away from growth and towards value. And one of the approaches I want to address this issue from is M&A. And I know that's something you know a little bit about. I think M&A is a really important way of looking at markets because it's one of the truest forms of price discovery. And I know M&A had such a bumpy year in 2021. So I want you, if you don't mind, just to go into a little bit of a background about what you're seeing in capital markets and M&A and a bit of perspective of what it was like last year.
Yeah, absolutely. Happy to, right? So, look, I've been active in the deal-making community for many, many years by now, both on the private equity side, but also for Refinitiv LSEG, being a very keen observer of market trends and engaging actively with our key participants. So if we take a look at what's happening in M&A, which is really the heartland of corporate finance and a big driver of market activity across the board, we can see a really interesting story. And we've seen some significant change over the last 18 months or so, right? So including in Q1, a very large drop in year-on-year volumes, which will surprise some observers. So, but let's take it back to basics, right? So Q1 of 2022 was yet another $1 trillion quarter. In fact, it was the 7th in a row, which does indicate a relatively healthy deal-making market. But it was also a 20% drop compared to the previous years. At the end of 2021, after nearly 2 years of ongoing pandemic crisis mode, but also booming capital and M&A markets, deal makers were in an optimistic mood, focusing very much on economic fundamentals, on business and investor needs, and local factors. And any concerns of external factors and adverse influences hit really historic lows. And this is very unusual. And it was proven out in January and February as deal making in the first 2 months of 22 hit record-breaking levels. And in fact, the first 2 months of 22 saw the largest opening year for global M&A in modern times, exceeded only by the final surge of the dot-com bubble in 2000. So more than 740 billion M&A transactions were announced in January, February, but volumes have then fallen to a slowdown in February and certainly through March. So the question then is, what do we expect to see going forward here in terms of what investors are doing?
So this lull in M&A activity we've seen in the first quarter isn't so much that M&A volume is low, it's really just relative to such a bumpy year in 2021. So that begs the question for me, what are the reasons why we're seeing this lull? Is the credit market tightening up? And, particularly for some of these commodity related stocks, are they finding it harder to access capital markets?
Yeah, so very good question, Russ, and there's a number of drivers for that. There's an element of deal makers and corporates becoming comfortable with operating in the new normal after the pandemic. So when the pandemic hit in 2020, that really pushed M&A volumes to almost grind to a halt. What then happened was a process of retrenching, of really reviewing corporations, shoring up balance sheets and focusing on growth strategy. So that then naturally led to an increase in both divestment activity as well as acquisitions as companies continued to pursue their strategic growth and options. Combine that with some really fundamental healthy conditions for M&A making, such as thriving capital markets, particularly on the fixed income side, combined with low interest rates, and you really had the perfect conditions for fairly extensive M&A markets and deal making. And what we've also seen, right, is a willingness at the C-suite level of really engaging with large-scale M&A transactions. So interestingly, what we've seen is a growth in what we call mega deals. So the very large transactions have increased significantly over the last 2 years as well.
Cornelia, thank you, because that's a perfect segue into the topic of ESG investing. So there has been a bit of a lull in ESG investing generally, and I want to know what you're seeing in terms of the funding of ESG strategies.
Sure, absolutely. Well, the first thing I'd like to comment on there, right, is that when you look at the returns, there's always a big debate, right, around is this an ESG bubble, and are some of those returns that we're seeing not really exceeding what you would get investing in non-ESG stocks or assets. And I think the key point here, right, is that generally longer term success here is based not on the short term investment horizon, where often non-ESG stocks can perform better. But if you look at a slightly longer time horizon, so say 3 to 5 years, we generally see that funds tend to outperform, ESG funds tend to outperform non-ESG funds. And really, what we're seeing here, there's a number of different things, but investors generally, so whether we're talking about institutional investors or corporates or even private equity, are waking up to the idea that sustainability is not a short-term trend, but it's a significant change in the real economy. And that therefore there are real sustainability risks as well as opportunities that may be material. So sustainable investing now is very much becoming not about necessarily a quick term win, but it's about securing those longer term financial returns. It's about mitigating risk as well as, of course, aligning with investor demand. And I think it's safe to say that many of our investors, from retail investors to the largest institutional investors, they now very clear on their desire to see their capital invested in a way that aligns with core values. And that is very much reflected in fund flows, for example. So Refinitiv Lipper provides in-depth research of fund flow data and analytics, and they've looked at flows into ESG funds, and it's certainly been a very strong year with inflows to green funds going up steadily. And very interestingly as well, if we take a look at February's mutual funds flow numbers and ETFs, there's been a loss, right? So it's lost about 10 billion collectively, but with the exception of ESG funds, right, which have seen positive inflows. So there's certainly a continued investor trend of wanting to invest into ESG. So, you can discuss whether it's a short-term bubble or not. My view is that it is not. We're dealing with a change here, which is driven both by a push factor and a pull factor. So the push factor very much comes from the regulatory side of things, right? So regulators across the world are introducing new measures around corporate reporting in particular, which are focused on ESG and sustainability. The pull factor comes from both investor and client demand, which is very much focused on seeing products and services aligned to ESG core values. And we see this reflected not only on the fund flow side, but also both on M&A and in the capital market. So green bonds, for example, has really dominated the green finance space and has increased very dramatically over the last decade. So we're now at a point where we saw $1 trillion issued in green finance last year, which is a fairly significant amount. And increasingly, there's interest in investors in terms of how to allocate capital meaningfully to projects and businesses that are going to continue to drive that transition to net zero.
Cornelia, thank you so much for your time. We talked about some really important issues there once again. Thank you very much.
Thank you, James.